Welcome back, folks, to another riveting edition of Looking Over the Manager's Shoulder. This is Greg Silverman, your Chief Investment Officer for the next 35 minutes. And I've been looking long and hard for a fund like Arca to present to you guys and to have a look at for ourselves. I've seen a lot in the blockchain VC space, but what I've really been looking for is something more akin to a trading strategy or event-driven strategy or special sit strategy as it relates to the ICOs and the coins themselves. And I think that's what we've got from Arca. On the line from Arca, I've got Jeff Dorman and Peter Hahn. We go way back with these folks, but I think Arca's been around for 2 years. And guys, I'm just going to leave it out to you. Please explain to us, run us through the deck. I'll take control of the slide deck. So if you want to fast forward me, just tell me to call a page number and off we go. So that said, please tell us a little bit more about yourselves, background of the fund, and just run us through the Arca pitch deck, please.
Sure. Yeah, absolutely. Thanks, Greg. So this is Peter Hahn, and I'm joined by my longtime colleague, Jeff Dorman. This is actually Jeff and I's third company together. Jeff, we've been in the traditional financial services and asset management space for about the past 20 years or so. Started working together about a little over 16 years ago in credit trading at a firm called FBR Capital Markets. After that, I went on to start an RIA and BD, ran a fintech company, founded and ran a fintech company called Harvest that was kind of a marketing technology for the asset management industry.
Yeah.
And where Jeff joined me there as well. And Jeff can get into his background a little bit too. And then, joined Arca about a little over 3 months ago. And, really appealed to me talking to Jeff. I've personally done some, Ethereum mining and had some, an interest in the space. But what really drew me to the asset class and very specifically to Arca strategy was, kind of looking beyond, cryptocurrencies and what people normally think of into, what is a really growing and diverse asset class where these digital assets can represent, real companies with real products, real cash flow that can truly be modeled. Arca is a financial technology and asset management firm really founded on the belief that blockchain is the technological foundation that's going to allow for a significant amount of innovation in the space. Innovation when it pertains to both investable assets and growth of the universe, but also how those assets can be transferred between different parties, both integrated into the existing financial system and outside of the financial system. And just, based on how early we are in the asset class, what really struck me is there is I think a generational wealth opportunity that is being created. And we're probably at the early stages of kind of a 20, 30 year bull run.
Excellent.
So in terms of the founding, yeah, go ahead. Sorry.
Jeff, you want to chime in? Tell us a bit about yourself.
Sure. Yeah, and thanks for having us. This is Jeff Dorman. I'm a co-founder and chief investment officer at Arca. Prior to starting Arca, I spent 20 years in traditional asset management and financial technology. I was an investment banker at Lehman Brothers. I was a high yield bond and distressed trader at Merrill Lynch. I ran some strategies for Citadel and some smaller hedge funds. And then as Peter alluded to, I also ran a fintech company with him called Harvest Exchange. So really blockchain and digital asset investing is sort of the combination of everything that we have done in our careers across traditional asset management and across technology. And when I started Arca, I was looking for like-minded individuals, people who had traditional finance backgrounds, who had asset management experience, who had done this before, and were applying all of the things we'd learned in our decades of experience to this new asset class. And that's what led me to partnering with Rain Steinberg, who is our co-founder and CEO, and he also was the co-founder of Wisdom Tree, as well as Phil Liu, who is a co-founder and our chief legal officer, and he's also worked for 2 decades as a securities lawyer for a variety of different funds. And Really our whole team now, we have 14 full-time employees across our firm in various aspects of the firm, all with the same pedigree and operational and financial excellence that we're all used to in the traditional world.
Great, real good team. A lot of known names that everyone's worked at. So tell us about, can I say DEF? Is that the Arca DEF hedge fund strategy? It's been a while since I looked at a hedge fund strategy. I've got to be honest with you.
Yeah, absolutely. So yeah, the Arca Digital Assets Fund, and I think as you mentioned at the beginning, you look at the landscape, and I think a lot of investors, their initial introduction to the space has primarily been venture, and perhaps direct investments in Bitcoin or a passive vehicle that looks at Bitcoin. But from a active management standpoint, it's pretty untapped, and you have some quants, you have some extremely small kind of technology individuals who probably made a lot of money in Bitcoin early on and launched a fund, but there's very few kind of, I would say, people who have a true institutional asset management and risk management background, and then there's even fewer who kind of run our strategy, which we really look at as a traditional special situation strategy, where we're moving kind of down the stack, looking at small, mid, and large cap tokens of companies that fit our investment themes. About 60% of the book or so is kind of fundamental asymmetric value, and about 40% target of the strategy is your more traditional event-driven special sit. And I think one of the reasons why this strategy works now is just growth in the asset class. So 5 years ago, it was predominantly Bitcoin, right? It was the entire space had a $4 billion market cap, and I think there were three tokens that had over $50 million in market cap that you can invest in. Fast forward to today, and the space is growing so quickly that even this slide is now outdated. You're looking at over 300 billion in total market cap. You're looking at well over 150 different tokens, that are investable, and probably even more so than that have a $50 million plus market cap.
Is there a minimum market cap that you need to have before you'd invest in something, or is that not really apropos? It's
probably not that relevant, just because the liquidity and the market cap aren't as correlated as they are in the traditional market.
Okay, let's keep going. I'm really eager to jump into your definitions of event and special sit, but I'm gonna hold myself back. Let's build it up a little bit.
Yeah, I think Jeff is best to touch upon this, because when he was talking to me about Arca and what they're doing, I, like probably 95% of all investors, looked at Bitcoin and Ethereum, and that kind of falls into your digital currency store of value. But there's this whole other world, and Jeff does a really good job of laying out what the asset class looks like now.
Yeah, well, I think this slide talks to it. So Jeff or Peter, take us through the different kind of tokens that are out there, I guess.
Sure, happy to. As Peter alluded to, just about everybody who comes into the digital asset space, whether it was 5-7 years ago or today, most people have heard of Bitcoin and maybe Ethereum, and that's really the entrance to this digital asset world. Unfortunately, a lot of people stop there and just haven't really been privy to how much has been built below that. And where we try to help new investors understand this space is to categorize the different types of tokens. So to start with, you do have your digital currency or your money or your store of value type tokens. This is where Bitcoin falls in. And there's a few competitors to Bitcoin. In our opinion, not many of them are actually investable. Bitcoin just has such a head start from a brand perspective and from a usage standpoint on any other form of actual global money, that I think it's going to be pretty hard to actually usurp Bitcoin's lead. But there are several others that fall into this money category that are trying to actually be a medium of exchange or a store of value. The next layer of tokens is what we call the platforms and protocols. And this is really your base layer technology. For those who are more technologically savvy, this would be equivalent to like what HTTP is, or TCP/IP, or SMTP, right? Those are base layer protocols of the internet and of email.
I know what that is.
Yep. And these are also being built now at the base layer of blockchain, where you are actually you're building like the building blocks that allow for everything that is being built upon these platforms. So it's almost akin to if you consider the Apple, the iOS store, the Apple Store being the iOS store, is being the platform and protocol level, and then Bitcoin being the money level, right? That being Apple Pay. So Bitcoin is to Apple Pay what the iOS store is to Ethereum. So these two, the platforms and the protocols are definitely very heavily invested in by the venture capital world. These are very boom or bust type technologies, right? They're either going to be huge or they're all the way to security. They're certainly much harder to invest in as an actively managed fund, because there is no real value accretion mechanism. It's very binary. So we don't do a lot of investing in that world, but that is certainly a world that exists in this space. The next level, the next two levels really are where we find all the value in this space. The third one being the asset-backed tokens. And asset-backed tokens are exactly what they sound like. These are tokens that are backed by some form of a hard asset or a hard income stream or profits or revenue, something along those lines. So this can be anything from tokens that are backed by equity, tokens that are backed by fixed income, or even some more unique types of assets as well. So for instance, my favorite example is there's an NBA player by the name of Spencer Dinwiddie who has tokenized his NBA contract. So he has a 3-year contract with the NBA. He obviously doesn't receive that money all at once. So he tokenized the future cash flows of that income stream under that legal contract and issued a token you can buy that has a fixed rate of return as long as there's no defaults on that contract. So there's a lot of different examples of asset-backed tokens, and these can be modeled and understood in the same traditional financial way that we're used to with stocks and bonds. And that's a growing part of the market. It's not as big today as it will be obviously 2 years from now, 5 years from now, but it's growing, and there's certainly some investable opportunities there. The fourth token type is probably the most unique and the most interesting, and it's certainly where we spend a majority of our time. And that's what we're calling pass-through securities or pass-through tokens. These are tokens that are effectively hybrid tokens in the sense that they have some form of utility in that you can actually use them in a form of either rewards or discounts on the company itself or on the platform itself. But also you're getting some sort of a quasi-equity or quasi-ownership stake by owning this token. So the simplest example of this would be there's an Asian company called Binance that is it's a digital asset exchange. You can go on there and actually trade.
Yeah, I know them.
Others. But they introduced a token called BNB, which in addition to giving you discounts when you trade on their platform, so you get fee reductions, you get discounts, you get other sorts of rewards for trading on their platform. If they introduce a new token launch, you get dibs on that token launch if you redeem some of your BNB tokens. So there's a real form of utility for owning that BNB token. But at the same time, the company uses 30% of their profits to buy back and burn outstanding tokens. So effectively, they're using their actual cash flow and their actual profits to effectively do a stock buyback or do a dividend. So this is a perfect example where these tokens are now giving you the financial benefit of the growth of the platform with which you're using, but also giving you some form of utility when you actually use the platform. So in our opinion, this has now become the greatest capital formation and bootstrapping mechanism the market has ever seen, because you are now incentivizing your customers to use your product and also gain as others join your product. So they become evangelists, they get rich, and they also get utility all in the same time. So it's really novel, and it's creating opportunities.
Yeah, that is smart. So let me just try and recap that back to you real quick so I understand it. So basically it's a utility token. It has some utility to it, but its value is actually its value is actually could increase, probably could decrease as well, but could increase because of buybacks or something like that. Okay. I was wondering how a utility token, could change in value, but now you've explained that to me. That's great.
And just to follow on that too, I mean, it's it's a really flexible structure in that companies can do whatever they want with regard to what the tokens represent. It's actually more akin to the bond market than to equities or commodities, right? If you look at the bond market, there's all sorts of different attributes of a bond, right? You have different coupons, different maturities. You've got callables, puttables,
right.
govies, yield, et cetera. That's really what this marketplace is becoming. You now have all these independent securities that have various attributes, and you have to model them and analyze them in different ways based on the properties that that the company has issued them with. So it's really unique. It's really interesting. It's incredibly busy because there's just more and more coming every day.
Right. Spoken like a true credit guy.
Exactly.
All right. Take us through the team, if you will. And yeah, take us through the team and just highlight the various competencies.
Yeah, sure. And as I mentioned in the beginning, right, I come from the traditional world, the banking background, the trading background, capital markets, asset management, et cetera. What we wanted to do was align ourselves and build a team around me that had different types of experience and could bring different elements to the table with regard to our research and sourcing and investment process. And you'll probably notice on here, we don't have a developer. A lot of this industry was built by developers and built by software engineers, and God bless them, we wouldn't be there without them. But we feel that it's much more important to have an actual investment team and a process and a risk management experience, because we really think that investing in this space is really no different than when you invest in any other space, which is, I've invested in every geography, every asset class, every product, every sector. You can learn those things, but the one thing you can't really learn is experience. You can't shortcut that. So we've surrounded myself with Hassan Basiri, who's a portfolio manager. He has a JD and a CFA. He spent 10 plus years at KPMG doing cross-border M&A. And that's an incredibly useful background for this space because he does a lot of modeling and cash flow analysis and even legal analysis to understand exactly how these tokens that we're investing in accrue value. Next to him, you have Katie Talati, who's our head of research. She comes from more of a early stage technology and venture background, where she is used to doing due diligence on early stage companies, management teams, product market fit, a little bit more of the deeper dive, longer term thematic type investing. And then we have Wes Hansen, who's our director of trading and operations, and he's got 20 years of experience in trading and ops across equities, debt, and digital assets. And he's probably the most valuable person in our firm, to be honest, because he is responsible for making sure that we are onboarding the right exchanges, the right OTC partners, the right custody solutions and admin solutions, and some of the stuff that we take for granted in the traditional world, right? You always hear the term two guys in a Bloomberg or two girls in a Bloomberg, but you can just pop up overnight, get a Bloomberg and plug and play with your prime broker and your admin and you're up and running. That doesn't exist in this space. All of the service providers are new. All of the counterparties are new. Really everything is new. And we spend as much time doing due diligence and risk management on the service providers as we do on the actual investments that go into our fund. And then we round that out with, sorry, go ahead.
No. Yeah, maybe you can just tell us quickly about the analysts and then we can skip through to the high level strategy.
Yeah, and then Sasha Fleischman, Alex Woodard, both young junior analysts and traders who honestly know more about digital assets than they do about stocks and bonds. This is the nice thing about the young people in this industry. They're not jaded by a traditional asset class.
Yeah, brilliant. Tell us about the strategy. Again, I'm curious about your definition around special sits, etc.
Yeah, absolutely.
Yeah, so go ahead, Jeff.
Oh, go ahead.
Okay, so yeah, this can be breezed through pretty quickly. So it's a long bias fund. We don't short, we don't take leverage. If there's a arb trade where we have literally zero directional risk, that would be the only reason to, hence we call it long bias. Special sits, the strategy, we're looking at liquid digital assets. Kind of 12 to 15 positions at any time. That's partially going to depend on the number of event-driven trades we have at any one time. The risk management is a major part of this because we're looking at, potentially smaller cap, more illiquid, tokens and securities. we have to be, very careful about our position weighting. That said, from a liquid standpoint, even though a lot of the strategy and the way in which you can interact with the company, the fact that there's no Reg MD, it can mirror venture. It's certainly venture type returns. There is liquidity. We can liquidate, really 90% of the portfolio probably within an hour, really. And then, from a security standpoint, that's another key consideration. In this market, we do have, custodial relationships with Fidelity and Coinbase, but then there's also a large element that, we're self-custody. And
right.
The next page. Really
I imagine
kind of meets.
I imagine a lot of investors are really concerned around security, right? Around the custodianship and storage of assets. So it's good to, I know Fidelity you've been getting into that space in a big way, so that's good, and I suspect other institutions will come in as well, given that the profit motive.
For sure, definitely agree with that. So highlighting
All right.
the strategy.
This is the slide. Yeah. Okay. Go for it.
This is the one, and this really is what makes us unique. And I think the team that Jeff put together, the research process that he'll explain, is what allows us to execute on this. So part of the book is event driven. It's analogous to long short equity event driven strategy. So we're looking at kind of 1 to 3 month hard catalyst. And, partially because of, just the information flow, the lack of competition, the way we can understand and get in with the companies, we feel that there's, true information asymmetry here and true real investable edge. And, there are a number of hard catalysts that are very specific to the industry. They could be, hard forks or upgrades or exchange listings. There's also a number of different arbitrage opportunities. So, we've been hitting at a higher batting average than one might expect in, equity event driven, where you certainly have a lot of crowded trades and, less availability, I would say, of true information edge. And then, the other side of the book.
So, sorry, Peter, just before you go there. So just kind of from the layman's perspective, which is my perspective, Bitcoin, I think it was called Bitcoin Cash. That was a hard fork, if I'm not mistaken, from Bitcoin, right? Almost like a split, if you will, or a spin-off. Is that the kind of event you're talking about here? One of them?
Yep, that's certainly one example of it, right? So effectively, developers who work on the Bitcoin code, they had a disagreement on the code and they forked it, or basically spun it off into a completely new blockchain called Bitcoin Cash. So that is an example of similar to a dividend or some sort, where there was new tokens created that were given to original token holders. So that is one of many examples of where events come.
One of many, sure. And how do you know about those events? I mean, how are they broadcast? Yeah,
it differs. There are certainly companies and projects in this space who err on the side of more transparency than less. Some of them have monthly blogs, monthly calls, and you can it actually looks and feels no different than a company that has actual regulated reporting requirements. And other times it's not as easily available, and you hear it through the grapevine and it's mosaic theory, and you figure these things out by going into the GitHub repository where the developers are talking and actually see the code that's being written. There's chat rooms, so there's certainly a fair amount of detective work that goes on in addition
detective
to
work. Yeah.
Yep. Exactly.
Go ahead.
Yeah, and the other side of the book is really thematic and what we call asymmetric fundamental. So while we can express a view on Bitcoin and have some Bitcoin in the book, at the end of the day, it's a big liquid token, and there's a lot of places you can go to buy Bitcoin, right? You don't need to pay us to generate alpha on Bitcoin. But looking at different projects, companies, and the tokens they issue that fit into themes that we think are, on the cusp of really exploding over the next, really 3-5+ years. And recognizing these opportunities, well before anyone else, certainly institutionally does. And right now, and we can get into a little bit of our themes later, But a great example is, I'm sure, as kind of there's a lot of talk about DeFi and decentralized finance and what that means, and that's something that we were identifying and investing in early 2019. And, for a long time, it didn't move. And now, obviously, we're still very early, but projects that are working are exploding and new ones are coming online. So if an investment, does fall within our theme, someone on our investment team will bring it to Jeff. We'll decide if it's something we want to look at. We'll look at the economics of the token. We'll look at, the company issuing, the technology. We'll try to, do user studies. And, we have a very developed and regimented process around research, investment committee, and then, ongoing risk management. So, Jeff, probably a good idea for you to walk through, what this looks like in practice.
Yeah, absolutely. And I think the key for us is, we've developed, standards and procedures and processes no different than what we have done in the traditional equity and debt world for decades. And we're just applying them to this new asset class. One of the things I always believed in when you run outside capital, when you manage outside capital, is you want to be very rigid in your processes and procedures, but you want to be very flexible with regard to the investments that go into the portfolio so that you can evolve as the world evolves. And certainly this digital asset space is evolving incredibly quickly. So from day one, we've come up with a research process in terms of how we are identifying different investments, starting from the top down with thematically, what do we believe is going to benefit over the next 6, 12, 18 months, and then specifically trying to find investments that match that theme. And then we go through the traditional due diligence process. We have an analyst that's assigned to it. They do a thorough review with an actual write-up that gets disseminated internally. We go through investment committee, which is a combination of portfolio members as well as people who are not on the portfolio team, just to get some outside perspective. And then once we, usually after investment committee, it ends with one of three things. Either it's approved and we go to the next step, or it's a maybe and there's a list of questions that the analyst needs to answer before we will approve it, or it's a no for a variety of reasons. And as you can imagine, there's a lot fewer yeses than there are maybes and nos. But once it becomes a yes, and it's something that we decide that we want to invest in, we run it through a proprietary system that I built 15 years ago in the debt and equity world, and we've adapted it for digital assets that we call Block Score. But really all it is it's designed to look at all the qualitative and quantitative factors that would go into an investment, everything from liquidity, timing, hedgeability, fundamental view, upside target, downside target. And we run it through the model just to see what the appropriate sizing should be for a position like this. And then throughout the life cycle of the investment, this block score is updated in real time. So we are very big in sizing in this industry. Obviously, we all know that the upside can be 100 to several thousand% when you get things right. So it's, from our standpoint, it's more about making sure we don't have major losers and we don't risk too much in any one investment or across the book, to make sure that we can achieve these gains without taking unnecessary risk. And once we decide to invest in it, then similar to anything else, there's an order that's put in by the portfolio manager, and the trader. So.
Are you there?
Yep.
Yeah.
Sorry. So.
Yeah, I got it. Sorry, you just faded for a sec. That's great. I mean, this is like what I like about this, guys, is it's quintessential hedge fund research process, a very institutionalized research process. So I like it a lot. I mean, it's very clear, it's very articulate, and it's just on a new asset class. So I think this looks lovely. I mean, obviously, I know from performance that it's generating alpha, and I suspect. I mean, do you come across a lot of competition in this space?
I mean, not that employs our strategy. So, typically when we talk to, potential LPs, they're either, and the asset class is so new, right? So they're exploring an investment in the asset class, and at the same time they're talking to us, they're figuring out how do they want to express it. So, it might be looking at venture, it might be looking at, comparing us to venture. Do we want to be liquid, illiquid? Do we want direct investment tokens? Do we want all three? But on the hedge fund side, no. I mean, no one. They're
Yeah, I can believe it. Most investors I speak to are still trying to figure out how to buy Bitcoin and store it safely, believe it or not. I mean, something as, which for you guys is probably child's play. That's what most investors are grappling with right now. If you can merely solve for that, I think that's an opportunity in of itself.
Yeah, for sure. And we all started that way. I think the difference is this really does take longer than other asset classes to get up to speed. And as a result, if you had asked me like, what's the perfect formula for active management? It's exactly the environment we're in, which is a growing asset class with a lot of investable opportunities, but very little competition because there are barriers to entry. And that's where we sit right now. This is an incredibly interesting opportunity set from an investment standpoint, and very few people are even aware of it, let alone investing in it.
Yeah, no, I agree. All right, I just want to be cognizant of time, guys, so don't want to extend our time too much with some of the folks on the line. Jeff or Peter, take us through the investment themes and then a bit of risk management, and then we can flip through the rest in short order.
Sure. Well, as we mentioned, we look at everything from the top down, and then we do bottom-up security analysis once we find the themes. So there was a fair amount of themes we were looking at in 2020. One was the growth of decentralized finance, or otherwise known as DeFi. And really all decentralized finance is trying to do all the traditional banking and financial services businesses that we all use today, but doing them without a centralized middleman. So everything from asset management to insurance to lending and borrowing or other prime services to decentralized exchanges. And we had a core investment across various parts of DeFi, which is, on average up 600 to 1,000% year to date. Another theme we look at is what we call tokenomics. This means that the token itself has a clear value accrual mechanism. So we mentioned at the top of the hour here how a lot of the protocols and platforms are interesting, but they don't actually accrue value to the token. We look very hard for the tokens that have a clear-cut value mechanism, whether that's through dividends or rewards or something like that. The other theme that we focused on is rewards and gamification, and this is really kind of the heart of what blockchain does, right? A simple definition of blockchain is that what the internet did for communication transfer, the ability to send emails and video chats and everything across boundaries for free, globally. That's what blockchain is doing for asset transfer. It's allowing you to transfer assets free and globally, permissionless, across boundaries very easily. And that lends itself really well to rewards and gamifying things, right? The idea of having in-game items that you can transfer to another game, or being rewarded for something that you do within a game. So this idea of being financially incentivized to be in this gamified world is a huge growth engine for blockchain. We'll skip staking for a minute, but the other one is sports and gaming. And this was even before COVID. We already had seen the at the game experience was starting to be replaced by the in-home experience, right? Everyone has 60-inch TVs and craft beers and neighbors. So we started looking for themes where blockchain could make the at-home experience just as good as the in-game experience. And we started investing across companies with tokens that were incentivizing people to continue to be huge fans and even have some governance over their teams, even if you never enter the stadium. And we've made a couple of investments out of there that have done very well since inception of our fund. So we're constantly looking for other themes as well, but this is where we're focused today. Right.
Let's talk about risk management for a second. And, it brings to mind, I think, what can I say? We've been through a boom bust scenario now with, the ICOs that came out, I want to say, well, it was probably about a year or two ago, where everyone was jumping, doing an ICO akin to an IPO, and then, a lot of people just, the whole market just capitulated, which I suspect was, the Bitcoin going from 20,000 to what, 3,000-4,000, although it's come back quite a bit now. So all of which to say, please tell us about risk management.
Sure. I mean, the risk management and price management are obviously two separate things, and we take that very seriously. So When we think about risk management, we think about first and foremost the processes and the procedures and the counterparties that we're using, like I already mentioned, making sure that we are not putting any of our investors' capital at risk unnecessarily in terms of where that risk is sitting. So we focus a lot on that. From the actual investment standpoint, when we talk about risk management, it's really about downside investing. It's 100% about making sure that forget what you think the upside is or what is going to go right. It's what happens if it goes wrong. And can you withstand the volatility? Can you withstand a mark to market? Would you buy more if it went down because you believe in it? And we look at this across the individual token level as well as across the portfolio level. In fact, the very first thing we did when we started Arca was we outsourced to a company, General Risk Advisors, who's been doing portfolio risk analytics for 30 years, to work with them on understanding the correlations, the betas, the VARs, and all the different risks that our portfolio represented. And then on top of that, we actually have a formal risk committee that we meet in person or via Zoom once a week, but also we do daily updates to basically channel check some of the decisions that we're making. So this risk committee is not just portfolio members, it's actually 2 portfolio members and 3 non-portfolio members. Basically, because in this industry, when it's 24/7 trading and there's no break, sometimes you get a little myopic, sometimes you get a little, you start to believe your own investment ideas too much. And it's nice to have a little outside channel check to question some of the decisions you're making and make you defend them and make sure you can articulate exactly why you're doing what you're doing. So we take this risk management really seriously. And again, we're lucky that we have, hundreds of years of experience across the various senior members of Arca who have done this in other asset classes and are now applying it to digital assets.
Definitely. I can see the crossover. How many positions do you have in the portfolio today? And what is a large position from the size perspective?
Sure, and as Peter mentioned earlier in one of the slides, we generally average around 15 or so positions that are, just under 8% each. But in general, it's usually more of a barbell. You usually have your 4 or 5 pretty high conviction ideas, which are going to be in the 10 to 12% range, maybe 15%, depending on what exactly it is. And then you're going to have a fair amount of, much smaller 1 to 3% positions that are or maybe a little more binary in nature, or maybe the liquidity isn't quite there to have a bigger position. So right now, as it stands today, we've got about 17 positions. But based on conviction, it's based on block score, it's based on that downside assessment as much as it is the upside assessment.
Okay. If it's okay with you, chaps, I just want to kind of run through the next few slides pretty quick. And let me just handle it if it's okay. Please chime in. It talks here about really the safety of the assets, which obviously is paramount. There's the performance track record, which I don't want to go into in great detail, because if anyone's certainly interested, they can reach back out through me. This was an interesting slide to me, is the correlation to, I assume BTC is Bitcoin, right? So there's a 0.81 correlation to Bitcoin and a 0.68 beta. So here's the question. Okay, and I know you guys are doing phenomenal work generating alpha because I've seen the track record, but we're so early in the game. Why should somebody not just, find a way just to buy and hold Bitcoin and get 68% of the upside and forget about the fees and all that sort of stuff?
Well, I think they could, and I don't necessarily think that they're mutually exclusive. So, we obviously have a fundamental view that there's, more returns to be had in, a more diverse digital assets and actively managed approach, because this space is growing and the investable universe is growing, literally every day. And, we and also look at it this way, a lot of the questions we get initially when we first talk to somebody is, how do you fundamentally value Bitcoin? And me, from my standpoint, I personally don't know, so we can have a thesis on Bitcoin and we can like it, but at the end of the day, we see more attractive investment opportunities. And, that correlation is lower than it was a year ago. It's lower than it was 2 years ago. And I would imagine it will continue to fall as, more, I guess, true investment and institutional capital enters the space.
That's true. Yeah. Okay. I'm going to leave up the contact details here. I've got two more questions, then I will hand it to you just for concluding remarks. The first question is hedging. You use the term hedge fund. It is long biased. My experience with the space is that everything tends to be somewhat correlated, like different coins tend to be somewhat correlated. How are you achieving the quote unquote hedge part of the portfolio?
Sure. Well, first of all, I'll start with, in my experience, there's three parts of a strategy get funds in trouble. One is shorting, the other is using too much leverage, and the other is having too much illiquidity in your book. So from day one, we are very transparent to our investors that we are not going to use leverage, we are not going to be shorting, and we are not going to have a book that is too illiquid, because again, we believe in the upside potential of what we're doing, and we don't want to add any unnecessary risks that don't really achieve performance. With regard to your correlation, though, correlation and magnitude are two different things, right? Two assets can be very highly correlated, but over longer periods of time, asset A can move up much more than asset B. So while there is a fair amount of intraday correlation, it doesn't really matter a whole lot when you look across longer time periods. There is a clear bifurcation between haves and have-nots in this space. There are tokens that fall completely out of favor and never accrue value and basically head towards zero. And there are tokens that are achieving these 500, 1,000, 2,000% type returns because they hit real product market fit and have a real value accretion mechanism to the token. So we aren't worried about the correlation from that sense in terms of hedging. But that said, we do pay attention to it in terms of our overall portfolio construction and our betas and our correlations and things like that. So in terms of how we hedge, we will use derivatives once in a while. We will use Bitcoin puts. We will use Ethereum puts once in a while as a market proxy. But for the most part, the best hedge is cash and making sure that you are doing the right research and are in the right assets.
Yeah. Well, if I may, I'll get on my soapbox for 1 second, because I've lived through the boom and bust times of hedge funds. And hedge funds really just became watered down beta at some point, right? Because this whole concept of alpha wasn't there, and what you were getting was a beta less than 1, and so you were getting less in the market, in a bull market. So, I think I'm with you guys, and my sense is that this whole space is in some kind of a bull cycle, which should last, some time. And being as it may, yes, I'd prefer you generate the 2,000% winners, and you get less of the ones that go to zero. So I suspect we're on the same page as far as that's concerned.
Yeah, and that's not to say that there aren't times where hedging makes sense. I mean, March is a great example. We were down a little. Right. We were down roughly 4% in March during a month where the market fell 50% in a day and ultimately was down 30% or more. And that was purely because the market conditions, volatility was so low heading into March that buying Bitcoin puts made sense as a hedge to our overall portfolio, and that plus cutting some event-driven positions and really recognizing the risks that had popped up in the market ultimately preserved a lot of our investor capital during a tough month. But not every environment is slightly different. There are other environments where we prefer to be heavy cash and just wait until we see opportunities and dive into those opportunities as we see them. So we really look, like I said, across markets, not just in digital assets. We're looking at what's happening in commodities and equities and fixed income, and we're assessing all of those risks, and we have hedging tools available to us as needed. But ultimately, as you stated, our goal is to protect against that downside while still capturing this market's upside.
Yeah, exactly. Okay, final question. I know you guys are, my term, not yours, swinging for the fences, or certainly looking for capital appreciation from a fund like this. What are the possibilities of actually spinning off some kind of yield or income stream from the digital asset fund or digital assets in general?
I'll let you handle that one, Jeff.
Yeah, sure. It's a great lead-in. At this stage, we have found that most...
Fun too? Sorry, go ahead, Jay.
At this stage, we found that a lot of investors seem to have like an on-off switch when it comes to digital assets. They either want to be in or out, and if they're in, they aren't necessarily thinking through all of the different types of strategies that exist today. Over time, and that's why the digital assets fund, we feel, is the best representation of what exists today in the market. But over time, we do expect investors to specialize with regard to specific risk return profiles that they're looking for, or specific yield targets. And we actually think an income fund is the next fund to launch out of Arca. There are opportunities in this space right now to generate consistent 8 to 15% yields. And it's really simple why that is. It's largely because this is a capital constrained industry. There's just not nearly as much money in this space as there is.
Right.
And as a result, that creates opportunities, whether that's cash and carry trades, whether that is lending opportunities, et cetera. And on top of that, there are actual hard assets that are, spitting off real cash flows that are producing yields as well. So I think an income fund is next. And I think there's going to be a huge opportunity, especially from the fixed income investor space right now, that is no longer able to achieve, those 3 to 8% yields that they're used to. And that does exist in this space, and we look forward to helping investors meet their bogeys.
You said 8 to 15, not holding you to it, but that was the numbers you cited.
No, that is real. 8 to 15 is what exists in this space today.
Wow.
And certainly, like I said, for the traditional fixed income investors who are targeting, even less than that, there is opportunity. Yeah. There's opportunity here to generate a very good risk-adjusted returns in the single to maybe low.
Absolutely, yeah. I mean, you think about high yield is yielding less than that, which is fairly liquid, and then you look at private credit, which is yielding in that region, but is as illiquid as anything. So yeah, certainly room for growth. All right, guys. Listen, this is terrific stuff. I really like it. As I said, I've been hunting for a while to find something of this nature, and obviously you've thought about it, and you've thought about it deeply, as evident by the work and the team that you put together. So let me just hand it over to you for any final words. If anyone wants to contact Peter or Jeff, they can do so through me, or I will put your contact details on the webinar. So final words.
Jeff, why don't you take it?
Sure. Yeah, and thanks again for having us, Greg. We appreciate the opportunity. I can just reiterate that I've been doing this for 20 plus years now, and this is the most fun I've ever had. My team is underpaid and still works harder than any team I've ever worked with, because they just really believe and love this asset class. And it is, the best opportunity set I've ever seen. And I can say that definitively, that even 2+ years in, and after the returns that we've had, it's still the best opportunity set that I've seen in the market. So I'm really excited to continue to help educate new investors as they learn to navigate this space. A lot of the LPs that we have today are not only putting their money to work with us, but they're also very active two-way participants with us, so that they can learn and grow as this market grows. So we look forward to the opportunity to work with any and all of the people listening to this. And we see a lot of opportunity, and are excited to continue to put money to work in the space.
Great. Well, thanks, guys. Thanks for coming on board, looking over the manager's shoulder. Enjoyed it.
Yeah. Thanks so much, Greg.
Thanks, Greg.